Thank you everyone for joining. My name is Paul Sutcliffe. I'll do introductions in a second, but welcome to our webinar this morning on decarbonisation and what we've called closing the delivery gap. So last month, EVORA released our white paper on decarbonisation, and we thought it was the ideal opportunity to update you on this, but also provide a bit more information on our partnership with Pineapple Partnerships. And I have Rupert with us from Pineapple, who's going to talk a bit more about the partnership, provide more information about the approaches that Pineapple take, and provide you some insight into decarbonisation and the support that Pineapple can give. What I'd like to highlight is throughout the session, we will there'll be the opportunity to use the Q&A function to ask questions. There'll be a question section at the end, so we'll just go through those questions. But don't wait until the end. Please use that and just drop your questions in, and I'll come to those at the end of the session. So thanks for joining. And what I'd like to do first of all is a bit of introductions. So. My name is Paul Sutcliffe. I'm a co-founder at EVORA. I am an executive director and MD of what we call the Special Practices Group, which is the strategic consulting function of EVORA. And within that function, we look after sustainable finance. But we also provide support on climate and carbon, and support our clients to develop strategies, but also implement strategies. And then importantly, optimize assets and support the optimization of assets. Previously, I was at DTZ, but that was a long time ago now, 2011. So EVORA's been going since then, and have been involved in real estate for a long period of time. Now, in our approach for supporting of optimization of assets, one of the critical things that we see the market needing to do is actually take action, not just make commitments, not just do audits, but actually take action. And as a result of that, we have formed a partnership with Pineapple. And with that, I'd like to introduce Rupert to introduce himself. So rather than me butchering an introduction, Rupert, over to you to kind of say hello and introduce Pineapple.
Brilliant. Thank you very much, Paul. And thank you everyone for joining. It's great to be here. And we've got quite an interesting topic to discuss today, moving from reporting to action. So my name is Rupert Snuggs. I'm the Managing Director of Pineapple Core, which is part of the Pineapple Group, Pineapple Partnerships Group, where we look to create scale solutions to urgent sustainability problems by creating partnerships. And the core partnership focus on commercial real estate, hence the capital letters up and down in the core name. And we built a partnership with EVORA, with Signify, the lighting people, Schneider Electric, the solutions and consultancy provider, and DCC, who cover multiple technologies as installers and managers and operators. And the idea is to bring this partnership together, or the idea of bringing this partnership together is to be able to deliver decarbonisation, create active buildings across portfolios, individual assets, to accelerate decarbonisation in the built environment at scale. We've got scale partners, scale deliverers, and we want to accelerate the journey towards decarbonisation. My background is a whole host of activities. I was an investment banker for a number of years. Then I worked for Unite Students as their head of strategy. Then I went back into banking as a relationship banker, looking at banks. Then I worked for a fintech that looked at listing single real estate assets. So I've always been around real estate, and the second half of my banking career was heavily focused on sustainability. So seeing the problems from the balance sheet side of banks, from the practical side as actual people who participate in the market, as well as from the technology and the innovative side across the board. And it felt more and more that the urgency is there, but the action it was not quite following it, and I really wanted to be part of that change and delivery.
Thank you, Rupert, and more from Rupert shortly. But I wanted to talk a little bit about the delivery gap and the key findings from our white paper. So a lot continues to be said about decarbonisation, about net zero carbon. And at EVORA, we're exposed to that every day. So we're involved in decarbonisation discussions on a daily, weekly, monthly, hourly basis. And we also sit on a lot of data. So we hold a lot of information for our clients uh, and understand a lot about performance data of the portfolios that we look after. So we thought we'd take a look at that on a scale basis, and have a look at the link between commitment and progress in particular. And I'm going to talk you through some of the findings that we've made as a result of that analysis. And spoiler alert, it's not a great position. We're not in a good position and we need to move things forward, which kind of emphasizes the requirements that to progress at scale that Rupert's just talked about. So first of all, we looked at one of the pieces of evidence we used was GRESB, and we looked at GRES data for 2025, and we looked at the commitments that were being made and the results. So GRESB measures performance and practice, and so from a practice perspective, we looked at the number of organisations that have ESG policies, and 81.5% of overall global GRESB survey respondents had an ESG policy. Now, some of you may say, well, hang on a minute, Paul, that doesn't mean that you've got a net zero carbon commitment within that policy. But if you think about a policy, policies should address issues that are material to real estate businesses. And clearly one of the most material issues, if not the first priority material issue in real estate is carbon from a sustainability perspective. And so as a result of that, you would expect that these policies address and make a degree of commitment to net zero, and the vast majority of them do. So there's lots of commitments out there. 81.5% of survey respondents made those commitments. And yet when you look at the actual performance, the global like-for-like GHG reduction that was reported, it was down at minus 0.23%. So a reduction of 0.23%. So a very, very small reduction in decarbonisation. And then when we look at CREM analysis, the decarbonisation pathway tool that's used by a lot of you, we find that to stay on a 1.5 degree pathway, buildings globally need to reduce their emissions by 2.9% per annum. And then if you take UK offices as a specific subsector, so I've just looked at UK offices as an example there, we in the UK for offices need to hit 5.8% reduction on carbon by to maintain alignment per year, to maintain alignment with the CREM analysis, not to hit net zero, but to maintain alignment with a 1.5 degree global warming target by 2030. So effectively, we're working in the industry based on the data that we've got at roughly 1/12 of the speed that we need to. So yes, lots of commitments, but in simple terms, not enough progress. We also took a look at some of the data sets that we've got in to hand. And in one particular portfolio, large portfolio, UK assets, over 1,500 assets, they reported over a 3-year period a significant carbon reduction. It was roughly 35% reduction in carbon. So great, you may say. So this particular case is an outlier and doing really well. But then we dug into the detail of how is that being achieved. And the analysis is really interesting. So 57% of that reduction was achieved through grid emissions. So the grid decarbonisation has helped this portfolio reduce their emissions significantly. Another 31% of that achieved emission was through portfolio churn. And portfolio churn may help one particular owner of assets, but those assets that are being churned, have been sold, are going somewhere else, they're still underperforming. So it's not, as an industry, it's not addressing the problem. And only 12% of the actual savings could be attributed directly to active asset intervention. So again, 12% of the carbon came from active activity. The portfolio looked like it was decarbonising on paper, but this type of solution, this type of practice is not, forgive the pun, sustainable in the long term in terms of achieving the goals that we want to get there. So what are the blockers? What are the challenges that EVORA see in terms of moving things forward? And we've highlighted on this slide, you can see that we've highlighted 4 key challenges. And I was at a breakfast event yesterday, and we discussed these, and rather frustratingly, these are not necessarily new. everyone will be familiar with these, those working in decarbonisation, ESG specialists will be familiar with these in one way or another. But we still have to recognise them. We have to recognise them and get through them because they are causing a blockage, and the combined effect is clearly having a challenge on our industry's ability to speed up decarbonisation. So so first of all, performance gap. One of the challenges that we see, and part of this is education, is that buildings consume 20 to 50% more energy than their energy ratings, their EPCs, their energy performance certificates suggest. Now, I understand why. I think if you look at an energy performance certificate, certainly in the UK, an EPC evaluates regulated load. The regulated load is not the total energy consumption of a building. So there's an education piece here, but the key point is simply looking at EPCs alone doesn't mean that we're decarbonising. There is, from the data set that EVORA hold, we looked at around 2,000 EPCs, a subset of our data, 2,000 energy performance certificates, and there was no correlation between the energy rating and the actual performance of the assets. In fact, the EPCA rated were equivalent to, on average, to similar operational performance of C and D rated assets. So it's something that we need to recognise from a performance gap perspective, or a design versus operation perspective. The second issue is the capital allocation lag, and this is about timing and deployment. So we've highlighted already that in our case, 12% of the carbon decarbonisation reduction comes from active intervention. As an industry, we need to move decarbonisation capex forward, and we need to find innovative and appropriate and cost-effective ways of financing this and moving things forward. And for real estate assets, when it comes to refurbishment, that's the ideal time to sort of look at this. Climate pathways are also exponential, and capital planning remains linear. So we need to move forward on this process. And one of the challenges that I still see is that the additional cost for improving assets from a sustainable perspective is often reduced down when it comes to refurbishment time. So a lot to sort of look at there, and that's something that no doubt Rupert will pick up on. Then we have this split incentive, which again, a common challenge and something that we've seen is that landlords fund the capex typically, so they spend the money, tenants capture the savings, owners get a value uplift later, but ultimately the initial spend on any sustainable refurbishment activity or sustainable improvement activity benefits the tenants, not the landlords. So there is this view of how do we move forwards this? How do we break down this barrier? And green lease clauses are largely either negotiated away, or I would not use the term green lease clauses, but clauses within leases that address sustainable factors are often either negotiated away or, in my view, actually focus more on sharing data, which is good, but doesn't necessarily mean improvements. So the barriers that we see from an incentive perspective, they're structural, they're not technological. The technologies, the trends, the software and the kit, the equipment is there for us to exploit and reduce our carbon emissions. But structural barriers in terms of the way that landlord-tenant relationships are run and assets are managed in the real estate industry causes problem. And the fourth challenge that we see is regulatory divergence, which is effectively a fancy way of saying that regulation changes between different jurisdictions across Europe, across the UK. Even if you compare, for example, energy performance certificates in the UK versus in England and Wales versus Scotland, there's a difference. That divergence causes confusion, causes challenge, and it means that there is a lack of understanding and clarity in the industry as a whole in terms of how to address both compliance, regulation, and decarbonisation in an efficient and cost-effective way, especially for clients that have portfolios that are multi-jurisdictional in nature. So lots of challenges that we see there that all add up to this kind of effect of stifling progress, of limiting progress. But one thing we also see is at EVORA is that the term brown discount, i.e. discount for in the value of assets, sustainable assets, is already live. We see this, and also I've added at the bottom there, you see on the slide, sources of information. So we've looked at JLL data that's been published, MSCI, and GRESB information. So it's not just EVORA saying this, but we are actively seeing that there are discounts being applied for assets that are considered to be underperforming. And when you factor that into the other facts on this slide, you recognise that there is a challenge but an opportunity. So in simple terms, there is significant demand for low carbon space, and there is a view that this will outstrip supply by 2030. It's already 35% short in London. Guidance shows that there's a green rental premium of London of 11%, 7% in North America, and 10% in Asia Pacific. And that when real estate professionals were surveyed, 50% of those, over 50% already, highlighted that they're observing active brown discounts. And that's certainly something that at EVORA we see. And the final point here is that, and again, this links back to labelling and green building certification, is that this is one particular example of an asset. It's a multi-use residential asset that EVORA are working on. It was developed and completed in 2020. It's got a BREEAM excellent rating. But that BREEAM excellent rating doesn't mean it's carbon neutral or decarbonised or energy efficient. To maintain its alignment to CRREM pathway, not net zero, but to maintain its alignment to CRREM pathway, a 1.5 degree reduction in carbon emissions, it needs to spend 2.8 million by 2036. So these are significant investment activities that are needed to protect the value of assets. You'll note as well that I talk about brown discount rather than green premium. I think that my view is that a green and sustainable asset is effectively an efficient and sustainable asset in the broadest sense of the word. That brown discount is really around the discount that happens where buildings underperform from a sustainable perspective and are identified as underperforming from a sustainable perspective. And also we're seeing this pick up relatively quickly. So when markets correct risk, it will happen suddenly, and it's not a gradual change that we're seeing in the market here. So from a risk perspective, we've already talked about brown discounts. We're seeing brown discounts in live transactions. I've talked a bit about some examples, but again, our analysis shows that 58% of UK commercial assets will miss the 1.5 degree CRREM alignment pathway by 2030 unless active activity is in place. I've not talked about grid connection, but I see challenges in terms of electrification of buildings that needs forward planning as well, because there are grid connection queues that are delaying electrification of buildings or slowing that process. And also regulatory non-compliance. First of all, you've got to figure out how regulation affects buildings and affects portfolios, but then secondly, regulatory non-compliance risks liquidity lockout. And in simple terms, if you've got assets that are considered to be non-compliant, maybe from a leasing perspective, then that will reduce your pool of potential future investors, future owners of those buildings, and that's a proxy for that has an impact on liquidity, and that then has a proxy for value. So there's a risk side there, but there's also an opportunity, and some of the opportunities that we've identified are principally around the brown to green arbitrage and the fact that the discounts that we're starting to see applied in this brown discount scheme exceed the actual remediation cost. So if you progress remediation and you address the challenges that we see, then you'll be able to sort of gain value and protect, and at least protect the value of assets. And that's kind of really a critical important point there. There is obviously, you implement savings, you reduce your net operating income. If you reduce your net operating income, then you'll generate not just the ability to gain rental premiums for high performing assets, but your cap rates will help improve, will improve. And so a, a £50,000 saving on net operating income through sustainable activities with a 5% cap rate will lead to a £1 million valuation improvement. Or in the example that we've got here, a 4 million capital value will be preserved per £200,000 saving at a 5% cap rate. So there are opportunities to not just protect value, but enhance value of assets if we take this forward. And then the final point is that I'm going to raise on opportunities of fund managers with track records that show that they can not just make commitments, but progress those commitments, will be able to attract more capital from LPs who have their own disclosure requirements under regulatory schemes like TCFD, and also are actively looking to protect the value of their investments in the medium and long term. So whilst it all looks, the first 4 or 5 slides of mine are fairly negative in terms of progress that we've made so far, the upside opportunity is really, really quite significant. So the last for me, how do EVORA take this forward? So our approach is 3-stage. And I think as an industry, sustainability consultants and advisors need to move beyond simply running audits and churning audits and producing outputs. There needs to be this progression and a connection to support asset optimization. And so our approach, and we moved our approach to look at, first of all, understanding the portfolio in more detail. So let's start with understanding commitments, refurbishment timescales, lease breaks, system replacement timescales, what can be fitted into those activities, and then layer over the risk scenarios. So yes, we use CREM, but the industry as a whole uses the CREM alignment tool to evaluate decarbonisation pathways. Look at what's needed and then prioritize, understand which assets need to move forward first, how do we move the portfolio as a whole forward. And importantly, 3rd stage is work with our partners to both plan activity, applying shadow carbon prices where possible, not where possible, applying shadow carbon prices, calculating carbon adjusted net operating income, and then bringing solutions in partnership with Pineapple to investment committee to support and aid the understanding from a financial perspective of the value of actually taking sustainable action. So that is the approach that EVORA take. As I've highlighted, one of the critical phases here is to take action, to stop navel gazing and to move things forward. So with that, I'm going to pass over to you, Rupert, and to introduce the Pineapple approach.
Brilliant. Thank you very much, Paul. That was great. If you can move on to the next slide. So again, everybody, welcome. So this is brilliant that we're working with EVORA because, of the data and the analysis they do, it brings out these hard facts that whilst progress on the surface seems to be made, the assets aren't particularly being decarbonised or changing, and shifting responsibility from one portfolio manager to the next is all very well, but ultimately these buildings need to be decarbonised. And a stat that gets thrown around that, I sort of like but hate because everyone uses it, but it really does highlight the urgency is that 80% of buildings that exist today are going to exist in 2050. So if we're going to hit those net zero targets, we need to be looking at retrofitting. It's not just about building new properties to average down the carbon impact. We have a lot of existing buildings that need to have work done on them. So where do we come in as Pineapple and where do we come in as Core? So as I said at the beginning, Pineapple Partnerships is a group that looks to tackle the world's biggest challenges in sustainability, build partnerships to be able to address them and at scale. So we look to commercial real estate, with that simple 80% fact, is a big challenge, a really big challenge that needs to be addressed. And it really needs to be addressed at scale. Ticking off building by building across a portfolio of 500 assets is not going to make the progress that needs to happen. And back to Paul's point, if we're traveling at 1/12 of the speed, something needs to be scaled up and quickly. So we looked at the 3 main challenges in the commercial real estate market. Often there's a skills gap, lack of knowledge of how to implement. Yes, there's all the reporting and these are the interventions that need to happen. But what is a good light bulb or lighting? We were in a building last week where lighting was installed 2 years ago. It's already yellowing. It's already, not up to scratch. It's already using more energy than it was. How do you know what a good lighting supplier is or not? And that goes across all technologies, solar panels, heat pumps, insulation, etc., etc. So we bring our partners that can overcome those skills gaps and provide real practical advice with, evidence based behind them, long years of skill, highly skilled employees and workers. The second thing was the fragmented supply chain, challenges in getting the necessary equipment and kit, and also that knowledge through the system to be able to deliver in a fast and scalable way. And again, partnering with large scale global partners, it enables us to do that. And finally, which is probably an area that's sort of most pertinent when we started talking about this a couple of years ago, is the broken finance. Interest rates have gone up. We've got spiraling energy costs, all sorts of challenges, and not just energy costs, equipment costs, kit costs, everything. Inflation has been quite high in our lifetime experience. I'm listening to a podcast on the 1970s, and we're nowhere near that level, but it's still challenging. And within all the models of portfolio managers, of tenants, these are putting massive pressure on those profit lines, even if there is profit visible. So we sort out partners that could provide innovative finance to be able to help get over that initial hurdle, start generating income and better margins on those properties that can then be recycled into the rest of the portfolio. And we're really fortunate to have 50 million of funding from one of our partners, DCC, as an initial opener to be able to support that. And how do we do that? So we saw those challenges. We work as collaboration. We've got technology and solutions, finance and optimization, innovation to bring solutions to the market. So market leading skills, leverage supply chains that can deliver at scale, and then innovative and blended finance that can help start that journey without having to sit around either worrying about the capital that's required, worrying about over leveraging. We can start delivering by flipping CapEx to OpEx in some instances, asset financing that can reduce cost, energy as a service, lighting as a service, all sorts of different structures that can reduce that CapEx call up front and move it into an OpEx. So, Paul, if we move on, if you don't mind.
Yeah.
So, the main question I guess you hopefully have is who are we? Well, we're Pineapple Partnerships. What we have on the left-hand side are our primary technology solutions providers. So Schneider Electric, global leader, voted #1 sustainable company in the world for the third year running by Time Magazine last year. Transformation from in terms of energy, electricity, grid systems, entire systems across portfolios. Absolutely fantastic company. They make a lot of the kit, but it's the design and the software and all the systems and structures behind it that really drive that efficiency in the market, including planning, structuring, and then delivering going forward. DCC is a leader, seller, and marketer in and distributor of energy products. So they do fossil fuels, but all the way across to green technology. They're the largest solar panel installer in Europe last year. They do EV charging. They install HVAC, all kinds of kit, as well as all the operations and management that go with that. And then Signify, which is the rebranded Philips Lighting, is the world leader in lighting, and they are the #1 sustainable lighting company in the world. So these are huge global brands that can deliver at scale. We can do and run analysis with them. We can do everything together with them and build together a combined package rather than individual companies coming in and saying, well, I can do solar, I can do lighting. Actually, by looking at it in a system way, we can combine that technology with Schneider BMS that can actually manage the solar system, which can manage the battery, that can integrate with the lighting and the sensors that have come with the lighting and actually drive even more efficiency after that initial install. And then on the sustainability efficiency side, we've got EVORA, who you all know so well, and we know the work that EVORA do, which is fantastic and gives us that real starting point and that base data point from which to build a really effective and impactful delivery pathway. And we also work with innovators as well. So PRS, they've got groundbreaking UV light that can filter air conditioning systems, which doesn't just deliver healthy buildings, but can actually reduce energy costs by up to 30% within buildings because you can recycle clean air. And then measurable energy, automates plug sockets. The simple example is always you have a plug for a fridge in a pub. The pub shuts at 11:20 at night, where you can turn off that fridge at 10:30 and still have the drinks at the right temperature, and it doesn't need to switch back on until 11 o'clock the next day. But you're not sitting there running around, turning off the plug sockets and turning them back on. That's a very small scale look at how they do, but a nice example that can go completely across mass buildings, huge office blocks and retail parks, etc., etc. So we believe we brought together the right team that can deliver. And whatever point we sit together, we discuss, and we would come to you. We're already engaged with a number of EVORA clients and other portfolio managers, where we sit down in a room, we bring everyone together. We've looked at the data with EVORA, we've done that initial analysis, the CREM pathway, looked at the GRES, where are the sort of the red lights, but where are the green lights? We've looked across the ROIs and what technologies are going to be sort of more suitable in one instance, maybe not in another. And we sit with you and we design with you, what are your key targets? What are your drivers? Is it scope 1 and 2? Is it scope 3? Is it energy reduction? Is it cost reduction? All different factors from everyone. And then we work out a pathway asset by asset, but also across the portfolio. Do we go for a technology first, or do we deliver on an asset basis? And that phase is what we call the discover phase, which is the top left-hand corner of this slide. What do you need to do? What do you want to do? Where do you want to be ideally? And then we discuss what the best way, based on the information we have, that we believe you can get there, and work with you how to build that path. Then we move into the design phase, which is the real technical work with our technical partners. This is site visits, this is looking at single line diagrams, going beyond just looking at the half-hour data, just walking around the sites and really getting a feeling of what's going on. Then we move into deliver, which is getting the interventions in place. And then most importantly is drive, is continual improvement. In the first pass on any intervention pathway, you're not going to do everything in the first go. But it's about choosing in that discover and design phase, what are we going to do in phase 1? Are we going to be putting solar on the roof and battery and start generating energy that can free up a bit of that OpEx to be able to do other interventions? Or, do we just look at lighting? Or actually the driver is, I've got a 2029 deadline and I have to electrify my buildings because I made that commitment. Great. Well, then we'll look at, switching out those gas boilers maybe ahead of time. But if you've got commitments and your investors are looking for that, then we can look at it that way and bring in the other technologies later on. So it's really important that we understand the drivers from your perspective, and that can help us design the best pathways for you. But we don't stop there. We keep moving round and round the cycle, making sure that your building hits those targets, and ideally, from our perspective, that you move through them and beyond and get right to that CREM position, net zero position, and even a net positive position in the future. So that's where we sit, and that's how we work together with EVORA. It's moving that. I think the great thing that we have is that a lot of the data is there. EVORA have done a hell of a lot of work with you and your portfolios. We've got the data. When we talk to our technical partners, the first thing they say is that we just need the data. We need to understand what's going on. There is no point planning anything until we have that. How does the building work? What's the energy consumption? What's the mix? What's the local grid? Until that's done, then there's really no point planning. We can set targets, we can set, aims, timelines and stuff like that. But the real planning and the detail and the action can't start until the data's there. The position you're in with EVORA is you're there already. So actually the really hard work has been done. And so then we take that and we turn it into practical pathways with our partners, which is great. So it's quite an exciting place to be at this moment in time. So I guess, Paul, we move to Q&A. I think we've got about 9 minutes left, so we're almost on perfect schedule.
Yeah, very good. Yeah. So Rupert, I've got a few questions. I'll fire them over to you, Rupert, and then maybe contribute as needed. But the first one is, we've talked, and our EVORA's analysis shows that we're decarbonising too slowly. Yeah, our slides talk about 1/12 of the speed required. Are you optimistic or pessimistic about us actually getting there? And what do you think needs to change?
I think it's a good question, because I think you can look at that speed going at a 12th is not good. I sort of have a fundamental belief in the capacity of humans to act quickly when it matters and when things are needed. And I think your point earlier about that, that shift, that brown discount is going to start kicking in quite quickly.
Mm,
And I think when that flood comes and people suddenly the market shifts to realizing that actually having old buildings or owning old buildings or even renting old buildings is becoming more and more expensive, or not old buildings that haven't been updated or retrofitted,
yeah.
there's going to be a fast change in the market. And I think sentiment, I think it's going to be more a groundswell rather than top down. Regulation is great and that will help and that normally pushes, that can help push people in the right way, but can also create false incentives. I think the smart asset managers out there and asset owners out there realize that in this in this challenging world where energy prices are uncertain, that resilience of buildings and resilience of energy usage of buildings is going to become more and more important, either for sort of a nation or actually just for a tenant going, how can you guarantee that my power won't run out in the middle of December when, I'm trading or I'm, in the middle of a conference call or whatever it is. If you can
Mm,
start building more resilience into each building, that's going to be
mm,
so compelling to tenants
mm,
who are coming into the buildings. And I think, as a marketing strategy, when you're marketing a building to tenants, we've got these great energy scores, which means you're going to pay less on the day to day. And, 40%, 50% of the energy is not reliant on the grid and is not reliant on fossil fuels.
mm,
Therefore, you can have complete autonomy and resilience, and you're not going to have any problems with either spiking bills or, blackouts or anything like that. And I think as we sort of know and see on the background, the grid is going to become more and more constrained as we electrify. And I think buildings being sort of their own individual power plants is going to become much more important.
mm.
So I
I
think
think
the
from
capacity for change is there. I think the urgency will suddenly kick in as the grid starts getting more and more challenged and stretched. That's going
yeah,
to really push the movement forward.
yes, I would agree. My perspective on this is that and I think you used the word, we have humans have a capacity to change quickly when we need to,
Yeah.
and we need to, uh, but when we need to, it needs to be demonstrated sometimes. We need to be, so I think there need to be, unfortunately, a few shocks, and but that brand discount needs to continue to progress. But as that's picked up and recognised more widely by the industry, then we'll see action. We'll see action very quickly.
And I think that's right. And it sort of comes on to a point we've discussed before and coming on to later, about talking about it and,
Mm,
sort of the push against ESG, particularly in the Trump world. Do we see that as a challenge or a difficulty? And yeah, I was on a panel, a few weeks ago with our partners and Signify and the head of sustainability and strategy, Alice Steenland, was saying, it's sort of sad because we talk to a lot of companies today. Yeah, look, it's fine. We're getting on with it. We're getting on with it. We're doing it. We're decarbonising.
mm,
And this is particularly in North America, but we're not shouting about it or anything like that. And her point was, well, in one sense, that's really good because progress is being made.
yeah.
But in another sense, that silencing of what you're doing and being proud of that you're, improving your buildings, you don't have to talk about it from a sustainability perspective. You're proud that you're making your building more energy efficient, so it costs you less, so you can make more profit. You can look at it in a purely capitalist term
Yeah.
rather than a sustainability term. And I think I always say it's the first time ever that the two have been aligned. By doing sustainability, decarbonisation interventions, you will make more money.
Mm,
Whereas I think the shift in awareness of that hasn't quite happened yet. And that tipping point hasn't come, it wasn't 20 years ago. It has come relatively recently. But all the technology is there to do this, and now it is a profit generator rather than a sapper of profit. But if we're not talking about it, and we're not talking about why it's successful, and talking about the fact that actually I put in a load of lighting last year, and now I've got returns, it's paid back within 12 months. I put solar on, and it's paid back within 3 years, and now I'm making much more money off this building than I would otherwise have been doing if I hadn't done anything, and the asset value's gone up and everything's going well. If we keep shouting about that and talking about it loudly, then that will help when maybe sort of slower movers to market come and go, well, actually, I feel a bit more comfortable about this because the building over there, the building there, I was talking to someone at dinner last night, that guy in the pub said this, my
Mm.
wife's sister said this, and actually it all becomes more familiar. And it's got to
Yeah,
make sure that we talk about it a lot louder and not be
yeah,
afraid.
yeah. That's really helpful. One, I think we've got time for one more question. Um, there's a question about grid dependency, which has been flagged at a risk and messaged a couple of times. Um, for asset owners banking on electrification, how serious do you see this risk? And are there any workarounds?
I mean, I think it is a massive challenge. It's a huge risk. I think it's a
Right.
huge risk. I think the race at which the grid is being sort of upgraded and replaced is not going to keep. Yeah, and in that sense, it's almost sort of a double-edged sword, isn't it? Well, we're decarbonising, we're electrifying, isn't that brilliant? But actually, the infrastructure isn't there to support it. What you can do and what we work with Schneider specifically on is, creating microgrids, so each building, as I said earlier, becomes its own power plant. So, with
Mm,
the technology of DCC, the systems of Schneider, battery optimization, demand side management, et cetera, managing how that power goes in and out of the grid and from your roof into whether it's your tenants or whether it's your own building, is going to
mm.
become really, really important. And a lot of the buildings we look at, 30, 40, 50% of the energy over a whole year can
Yeah.
be generated off the building with smart software, smart systems, and, good upfront investment in these last 20, 25 years. So you're looking at, a really good resilient system that will hopefully get over that hump, which I probably see 10, 15, 20, 25 years until potentially the grid will be able to support what is needed, maybe not. And then, you've got the technology, the building's familiar with it, and all you have to do is upgrade, and it's not sort of a huge
Mm.
mental jump. I mean, from your perspective, what do you think, Paul?
I yeah, equally see it as a challenge. I've actually personally been challenged by this because I want to fit a heat pump at home and don't have enough power uh, to,
Oh,
to
wow.
to 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 set that up. So it's a blocker that I've personally kind of seen. So I do see that as a problem. Um, I think understanding the problem, being able to qualify the extent of that problem is the first step, and then
Yeah.
having plans to work around that over a longer period of time is the way of addressing this, because there are certain aspects of it that are outside of an individual asset owner's control. But simply saying, "Oh, I'm not going to be able to get the power," is not the answer. Um, actually exploring it, understanding the opportunities is the kick off, the first step that you have to take.
Yeah, and being able to generate your own power. There are
Yeah,
lots of ways of generating your own
yeah,
power that can,
yeah.
that can help support,
Exactly. Of course, of course.
which is really important.
Rupert, thank you very much. We're at
You're
time.
welcome.
That's gone incredibly
It's
quickly.
good. Well, before
Um,
before we go, just a quick plug. We have a thing called Pineapple Day. So Pineapple Day, I think, is the 27th of June every year, as in World Pineapple Day, not just something we invented. And it's we then have a Pineapple Day. And what we're doing this year is sort of a special session that Core are running, which is effectively a workshop. Well, we'll have a bit of insight from sort of thought leaders in the market about, how we can move from reporting to action, how to scale, and ideas for scaling. So we've got the UK Green Building Council there talking about their recent paper. Paul will be there. Um, and looking at and then sitting down with our partners and actually bringing practical workshops. So we'll send an invite out to all of you after this. We've got all your email addresses. But I really encourage you to come along. We can sit with all the partners, bring your ideas, and actually email us before and say, look, I just want to know what a load of solar on my roof would be, or how much generally is a battery? How do these interact? Why is you know why when and why should I switch my fossil fuels to electric? All of that. So we've got little workshops that will be running. It's a 2 hour session, bit of talking before, and then sitting down around a table with us and the people who actually do this stuff and do the action, and come with your problems and challenges and say, look, uh, I'm thinking about doing this. What should I think about first? And it's
yeah,
normally we need single line diagrams and half hourly data. But it's a lot more complex than that. But we'd love you to come. So you'll see an
yeah.
invite for that hopefully later today, and we encourage you to all join.
Yeah.
So that's all. Sorry, Paul.
Absolutely. Thank you, Rupert. And I'm going to leave with a quote. I'm going to quote you, Rupert, to leave, and that's by taking action now, you will make more money.
Exactly.
Okay.
Exactly.
Thank you very much, everyone, and we'll be in touch and speak soon. Thank you.
Thanks,
Cheers.
everybody.
Goodbye. Goodbye.